Friends, the topic of today's podcast is battling bear markets. If you are always an optimist in the stock market, the bear markets tend to come at you with ferocity. You will have negativity surrounding you in different ways. From my experience, this negativity has taken different dimensions. And as our lives become more and more technology driven, the negativity hits you from the most unexpected quarters in different directions. Even people who normally don't take interest in stock market actually ask you questions which express their fears. So essentially, with every bear market, our ability to manufacture fear has grown exponentially. So in that sense, the index of fear and manufacture of fear has only got better with every bear market. And this bear market is quite unique because you have different ways in which this fear is manifesting itself. What are bear markets meant to be? Are there times when you should sell all your investments and walk away? Or are there times when you should not look at your portfolio at all and not worry about anything? Or are there times when you look at doability? Many people start thinking that they should not be in equity as an asset class in bear markets. I had this friend who said that I'm going to give a holiday to stocks. Now, from past experience, the best times when we made investment decisions, the most profitable investments, the investments that gave the highest returns, the best performing investments were all done in the worst of bear markets. But look around and you will have people keenly looking around, asking whether this is the best time to get out. Why is this happening? This is happening because of the kind of noise and pessimism that we are manufacturing. Sure, there is a problem in the economy. Things have slowed down in the election quarter, and there is no imminent return to a higher growth trajectory. These are a given. But what we need to look at is whether there are instruments at the hand of government and central bankers to facilitate that return to growth. Can the government and the Reserve Bank of India take decisions which can put our economy back on a better growth trajectory? If you look at past bear markets, I would think the government and the Reserve Bank of India is in a much better position today. Then why is this exaggerated pessimism? This exaggerated pessimism is directly an outcome of the exaggerated optimism that we had in the markets through 2018. And we spent a good part of 2019 thinking that time will reverse the problems. Today, that hope trade has thankfully come to an end, and we all accept that time is not going to solve problems. You need a lot of affirmative economic actions, and these actions must be taken at the hands of government, central bank, the various lending institutions in the country, and the corporates. So, we are at a point where responsible behavior has to come on a 360-degree basis. Ask yourself if you think it will happen or not. To me, this is not a choice before anyone, it has to happen. The question is not if it will happen, the question is when it will happen. And I am more than willing to assume that it will take longer than 1 or 2 quarters. So what are these 1 or 2 quarters meant to be? how am I supposed to use these 1 or 2 quarters as an investor? Am I supposed to sell everything and say, I'll come back in January and buy? Well, that is what the FIIs do. But for them, India is a round off number. All their assets are not in this country. They make assets across the world. If they lose money in one country, they make it up in another country. Or they would have already made profit in another country, so they don't want to be making more losses in India, so they just cut loss. So these are all trading oriented decisions. As an investor, should I allow my long-term investment decisions to be prefaced, to be based upon the trading decision of an FII? This is basically the question that one should be addressing, and not the fears which are being raised all around us, whether it's social media, newspapers or television, or just in casual conversation. Those fears are really not going to help us. But addressing this question, that should I as an investor react to how another person who is taking a trading call is behaving? More importantly, should I copy him and do the same thing? As an investor, my experience is that we have always done the opposite of what these traders have done and mostly benefited from those decisions. The only area is that you need to phase out your investment actions and not rush into anything. Not rushing into anything does not mean procrastinating for a very long period doing nothing. So one should strike a balance, one should be in investment mode, one should make the quality of his investment decisions better, and one should make use of the opportunity where the traders are throwing away very good investments. Essentially, we have an investment window of a few quarters where we can buy quality at reasonable valuation and at times quality at even cheap valuation. So this is an opportunity for the investor, and that is essentially what sense one should make out of the current situation. The questions which people raise about near term will probably be like a blip on a graph when you look at it after 5 years. So should those questions shut our minds to the opportunity before us? I am sure each of you is smart enough to regain your poise, get your composure, think calmly, and gradually build the conviction and courage to make those few investment actions which will later become the best investment decisions of your life. Happy investing, and thank you for listening to this podcast.